Hey traders, Mark here. Let me ask you a tough one today. How do you know when a strategy is dead? Like really dead. Not just in drawdown, not just taking a few losses. I mean when you pull the plug. That's what we're going to tackle in today's video, because this is something every trader struggles with, whether you're new or have been in the game for decades. And spoiler alert, most traders ask the wrong questions. It's not about when a strategy dies, it's whether it was ever alive in the first place. For those of you that are new here, my name is Mark Anderson and I run a 0DT hedge fund and have traded 0DT options for over 1,000 days in a row. So let's break this down, how to know if an option strategy is dead or not. So here's the setup. You've been trading a strategy, it worked at first, it made some money, you started to believe in it. Then the losses come, and they keep coming. You start second guessing everything. Did I mess up the setup? Did the market change? Is the data lying to me? You wonder, is it me? That's when the panic hits. You start strategy hopping, looking for the next best thing, chasing the high of the last good run. And that's how a lot of traders bleed out, slowly, painfully, and with no idea why. They don't give themselves enough time or size the strategy small enough to even have a chance in succeeding. So here's the twist. Before asking if the strategy is dead, you've got to ask, was it ever alive? In other words, did the strategy actually have an edge? Did you understand what that edge is and what types of environments cause a strategy to fail? Or were you just riding a hot streak, curve fitting into recency bias? Let's make this super simple. A strategy is like a business. If you're flipping burgers on the corner where no one walks by, that's not a business. That's a hobby. Same with trading. If you don't have a clear reason why your strategy should make money long term, it's not a strategy. It's just gambling. An edge is the reason your strategy should win over time. And there are really only a few kinds of edge that actually exist and last. Number one is the volatility risk premium. This is the classic sell overpriced options play, like being an insurance company, charging people more than you expect to pay out. Over time, that edge can be profitable. Two, behavioral biases. This is what drives momentum or trend strategies. Humans have emotion, and those emotions drive sentiment. They overreact. People are greedy and fearful. If you don't have a way to objectively evaluate your edge, you are just as susceptible to these mistakes as the rest of the market. Size conservatively to have plenty of room as these behavioral biases grow, and don't fall into the trap of FOMO. Develop repeatable trading strategies based on data that have remained persistent over long periods of time. If you've got a system that captures those behavioral biases consistently and a way to evaluate your performance versus objective numerical performance measures, you might have something real. You have unlocked the conviction, the honesty, and the math to make real money in the market. You are the tortoise, not the hare. The other types of edge are an illusion. If you think you have better information than the market, I doubt it. It's unlikely that you have better data and analysis than Wall Street quants with 10 PhDs, a supercomputer, and satellite imagery of supply chains. Trading faster than high-frequency trading bots? Good luck. So if your strategy isn't based on volatility risk premium or behavioral biases, you need to seriously rethink whether there's an edge there or if you're just playing into recency bias. How to tell if your edge is failing. Okay, so let's say you do have an edge. You've done the work, you got the data, you've done the back test. Now the question becomes, is this strategy just in a slump or is something fundamentally broken? Here's what I use. Monte Carlo simulations. Yeah, sounds fancy, but here's the simple version. A Monte Carlo simulation was created in the 1940s, named after the famous casino in Monaco. The simulation seeks to assess complex systems that involve uncertainties and probabilities in which traditional path dependence approaches like backtesting could not handle effectively. The simulation takes the average outcome of an event and the standard deviation of an event, then runs thousands of simulations to provide a random walk of the best, average, and worst case for the datum set. You plug in the stats and the computer runs thousands of theoretical trading paths, giving you hundreds of years of potential worst outcomes. It's like simulating 10,000 football seasons. Sometimes you go 12-4, sometimes you go 6-10, but you start to see what's normal and what's not. So if my real life results are way outside of that normal range, like losing way more than the worst case scenario or being well into the 2 standard deviation confidence interval, that's when I start asking hard questions. Is the edge gone? Did market conditions change? Did I mess something up in the execution or backtest parameters? You can see here are 2 examples of screenshots from a Monte Carlo simulation I ran. This one shows our average return of 20% with our standard deviation of 14%, which looks great on paper that our strategy will be profitable over time. Now let's look at an additional data from our Monte Carlo analysis. In this image, the devil is in the details. You can see, even though we still have a 20% average return, that the large standard deviation of 14% starts to come into play. We can see here that with a 95% confidence interval, that we are confident the system was working correctly, so as long as we achieve a profit greater than minus 0.2%. This still looks good and is a good strategy, but with the large standard deviation, this is not one that we would choose to be a large driver of our portfolio profits on a year-to-year basis. Another thing to remember, no single strategy is going to crush it all the time. That's why I don't run just one. I treat strategies like assets in a portfolio. I look at my portfolio like a well-diversified business with multiple return streams that provide cash flow in all market environments. If one strategy is in a rough patch, others might pick up the slack. That gives me the time to analyze, adjust my sizing, or just wait it out. It's like a basketball team. Your shooter might go cold, but if you've got a solid bench and you play good defense, you're still going to be in the game when those shots start to fall again. So when do I actually pull the plug on a strategy? Almost never. In fact, I've only done it once, and not because it blew up. It was because I found something better and I wasn't trading efficiently. I was running 2 strategies off the open of the market, and both were correlated to one another and had almost identical return streams, but one used twice the buying power and had twice the black swan risk. I was diversifying for the sake of diversifying. There are 2 trades did not help me become diversified. It made me feel like I had 2 trades instead of 1, and I was more protected, but in reality, it was just inefficient. I was making my portfolio more complicated than it needed to be and making less of a return on risk and capital than if I had just run 1. That's the key. Unless the fundamental reason behind your edge disappears, it's probably not dead. It's just underperforming. Markets are cyclical. Edges go in and out of favor based on market environment. That's not a failure. It's expected. But if your edge is gone, if people stop paying for options or humans suddenly become rational robots, then it might be time to retire the playbook. The way I like to think about it is, the edge and volatility risk premium and trend will never go away. It will always exist as sure as the sun will rise tomorrow. However, the way we extract those behavioral biases and volatility risk premium will go in and out of favor and change over time, and we will adapt to that. So the next time your strategy hits a losing streak, ask yourself, did I have an edge to begin with? Are my results still within the expected range? What metrics am I using to objectively evaluate my strategies? Or is something actually broken? This mindset shift will save you from emotional trades, wasted time, and blowing up your account. If this helped you to see your strategy with fresh eyes, smash that like button. Subscribe if you want more real talks about systematic trading, and drop a comment below. What's one strategy you're thinking of killing and why? I'll see you in the next one. Stay sharp out there, everyone.